Talk Media Limited, where complex ideas are explained clearly. Hi, I'm TaxMax. Let's break down today's tax topic.
Quick tax fact: partnerships don't pay tax themselves, even when one of the partners is a company. In the UK, partnerships are treated as tax transparent. This means the partnership itself does not pay tax on its profits. Instead, the partnership's profits or losses are calculated at partnership level and then allocated to the partners, who are taxed individually on their own shares. This remains the case even where one or more of the partners is a company. Several different legal forms of partnership exist, including general partnerships, Scottish partnerships, limited partnerships, and limited liability partnerships, known as LLPs. For UK tax purposes, all of these are treated as transparent. The presence of a corporate partner does not change this basic tax treatment. When a partnership includes both individual and corporate partners, two separate profit computations are required. One computation is carried out under income tax rules for individual partners. The other is carried out under corporation tax rules for corporate partners. Once the partnership's profits or losses are computed, each company includes its allocated share in its own corporation tax computation. Losses can generally be relieved under normal corporation tax loss rules, subject to specific anti-avoidance restrictions that apply in certain partnership structures. Partnership accounts may be prepared on a cash basis. Companies, however, are taxed using an accruals basis. Where a partnership uses the cash basis and has a corporate partner, timing differences can arise. Income or expenses may therefore be brought into account at different times for the company compared with individual partners. One significant difference between income tax and corporation tax relates to loan relationships. Where a partnership includes a corporate partner, loan interest and similar financing amounts are excluded from the partnership profit calculation. Those amounts are instead computed separately for the company under the loan relationship rules. This applies whether the company lends money to the partnership or the partnership lends money to the company. Where a company controls the partnership, either alone or together with other companies, connected party rules may apply, particularly in relation to late paid interest. Companies are assessed to corporation tax by reference to chargeable accounting periods, which usually last 12 months. A partnership may have a different accounting date. Where the partnership's accounting period does not align with the company's accounting period, profits must be apportioned across the company's chargeable periods. This can create practical difficulties, as the partnership's final figures may not be available by the company's corporation tax filing deadline. In such cases, companies may include provisional figures based on management accounts, with later adjustments once final partnership figures are known. Clear year-on-year reconciliations are essential. The partnership submits a partnership tax return. This return includes a partnership statement for each partner, including corporate partners. Once the partnership return is approved, each partner should receive their statement promptly. Corporate partners then use that statement to complete their own corporation tax returns. A mixed partnership is one that includes both individuals and non-individual members, such as companies. Specific anti-avoidance rules apply to prevent tax-motivated allocations of profits or losses. These rules target situations where excessive profits are allocated to companies to benefit from lower tax rates, or excessive losses are allocated to individuals to obtain higher rate relief. Where allocations are considered excessive, HMRC can reallocate profits or losses between partners for tax purposes. Additional anti-avoidance rules can apply where companies are partners. These include salaried members rules for LLPs, which can treat members as employees for tax purposes where conditions are met. They also include rules taxing indirect benefits provided to individuals through corporate partners, particularly in close company structures. These provisions are designed to prevent employment income or value extraction being disguised through partnership arrangements. In summary, partnerships are tax transparent. Companies can be partners without changing that transparency. Profits are allocated and taxed at partner level. Differences in accounting rules can affect timing, and anti-avoidance legislation plays a key role. Understanding these rules is essential where companies operate within partnership structures. Why did the partnership argue with the company? Because nobody could agree who really owned the profits.
Educational content only, not advice. Rules can change. Thanks for watching. Clear explanations, one place, Talk Media.